there. Welcome to Trading Day. I'm Lindsay Biscaya. Let's get to some of the stories we're following for you in the BNN Bloomberg newsroom. Canada's inflation rate cooled more than expected last month. Data from StatsCan shows the consumer price index slowed to 1.8% in February, missing economists' estimates. Food and shelter prices also slowed, while gasoline prices fell more than 14%. StatsCan says the main driver of the slowdown in inflation was the ending of the temporary sales tax break, and the agency predicts it will likely affect March inflation data as well. Shares of BCE are trading higher today. The telecom giant and the government of Saskatchewan, along with CoreWeave and Cerebras Systems, will collaborate on one of Canada's most powerful data centers. The 300-megawatt facility will be dedicated to AI computing, and the first phase is expected to come online in the first half of next year. And we got some insight on the partnership from CEO Mirko Bibic.
Bell's going to invest $1.7 billion in order to build the purpose-built data center. Think about it as 4 data halls that are going to be brought online by the end of next year, with 2 major global AI leaders as our core tenants for this facility. At the same time, though, we made sure to have the ability. We've reserved a significant amount of the compute capacity to meet sovereign AI demand in Canada for Bell clients.
And in other news, Canada is considering joining the Joint Expeditionary Force, a UK-led multinational rapid response military group, as it looks to deepen security partnerships. Defense Minister David McGuinty says the country is assessing potential memberships, but is currently focused on rebuilding the Canadian Armed Forces. The review comes as Prime Minister Mark Carney meets with Keir Starmer in London. Defense Corporation and Arctic security are among the topics on the agenda. And we'll take a quick look at the markets. The TSX is up this morning, up by 0.6% at the moment. Seems as though investors are feeling a little more optimistic as we head into this week. Also watching for the Bank of Canada and the Federal Reserve rate decisions on Wednesday. Could be influencing things as we look at U.S. markets today as well. A similar story south of the border, all trading up today after such a volatile couple of weeks. The S&P 500 up by more than a percentage point. Dow Jones almost the same, and the NASDAQ up by 1.3%. Data from Statistics Canada shows the consumer price index slowed to 1.8% in February. Food and shelter prices slowed, and gasoline prices fell more than 14%. And here to discuss this and other market trends is Pierre Ouimet, Head Investment Strategist at UBS. It's good to have you join us today, sir. Thanks so much.
Yeah, pleasure to be here, Lindsay. Thank you.
Yeah, so I guess first off, let's just get your kind of thoughts on the numbers we saw come out this morning. Maybe a glimmer of good news for Canada, but it could be short-lived.
Yeah, I think you hit the nail right on the head there. It's a great number. I mean, core CPI is down, headline CPI is down, shelter's down. Food prices are still, well, they're down, but they're still relatively high, and that's a very politically sensitive number. I think 4.1% down from 4.8, so that continues to be an issue for Canadian consumers. So, but generally speaking, good news is good news. But as you say, will it last? That's the other thing, considering what's happening in the Middle East.
Mm-hmm. Yeah, I mean, there's so many factors, and obviously the Middle East is a big one, right? Gas prices falling in February, but I'm wondering, we'll start there in terms of like gas prices and oil prices moving forward, how you think that could impact Canada's inflation.
Well, it will. At the level they're now, we're already, and it already has had an impact on gasoline prices. So I don't know how they are in your neck of the woods, but they're close to $2 a liter here in Montreal. So it's that'll have an impact. It'll have an impact across the board because energy feeds into everything else. The industrial base, the agricultural base, and so on and so forth, all the way down. So it's probably the worst item within the commodity spectrum that you want to be moving up. So we'll keep a close eye on how this conflict evolves. And I guess right there, I mean, yeah, the jury is still out as to what they're doing, how they're doing it, and how all of this is going to end up, and what the end game is going to be.
That's kind of what I meant, right? Because like obviously you can see the big red numbers at the gas station that show you gas prices are up, but obviously the price of oil being up can impact so many different sectors within Canada, right? When you think about groceries, for example, like that could be impacted as well.
Sure.
What sectors do you think could be more hard hit in the coming months if this doesn't stop soon?
Well, everything is related to the consumer because in the end, a hike in oil prices is an incremental tax on the consumer. So that's why it's so sensitive. And that's why it's important to keep oil prices under control because what you're putting in your gas tank, obviously you're not putting it into other stuff as well. So and it's almost it's something it's unavoidable. It's not really. It's very very inelastic. So it's you got to drive to work. You got to do stuff. I mean, you might cut back a little bit, but it's a tax on the consumer. So. Anything that's consumer related is not very attractive. So the other aspect of it, if it's inflationary, if this persists and we do get higher prices for longer, then obviously that's going to affect monetary policy and the fact that maybe interest rates might not be going down, and some people might assume that interest rates might actually be going up. So some of the more economically sensitive areas of the market could be affected from that perspective. So it's typically, I mean, I look at oil shocks in the past, and the two sectors that have not done well have been consumers and financials. I'd be a little bit concerned about financials in Canada because the valuations are relatively stretched. The dividend yield is comparable to the market, which is kind of interesting. But yeah, banks have had a good run. But the valuations are a little bit stretched in this particular context. So those are two sectors I'd watch out for. Be a little bit more careful.
Or are there any sectors at this time, like I see in your notes, you think Canada might have an opportunity to lead in energy throughout this geopolitical crisis, but are there any other sectors that you think are more of a safe bet at the moment?
Energy and resources, for sure. I mean, that's, I just hope we're not missing an opportunity here because of some kind of political or regulatory sclerosis. I mean, there's a huge opportunity for LNG, natural gas, oil, developing our resources and being able to sell those resources east, west, and maybe not north, but south for sure, through into Asia, into Europe, and everyone's knocking on our door. But we're at capacity right now, which is very, very unfortunate because Canada, compared to the Persian Gulf, is a safe haven. And there's a premium to be paid for that. And I think a lot of buyers, energy buyers, are turning to Canada and looking very opportunistic as to maybe even in terms of developing resources as well, actually investing in the energy sector in Canada. But we have to have the proper regulatory and political environment in order to be able to do that. So it's I don't want to get further into that discussion, but that's not my domain to.
Well, and that's that's a whole other conversation, but it is a good point that there could be a lot of opportunities there for Canada, given what's happening right now. Just before we wrap up, I did want to get your thoughts on what we're seeing with the price of gold as well, because you mentioned gold didn't react as strongly to what we're seeing in the Middle East as you might have thought. What do you think's going on there?
Well, I'm surprised, but I'm not. Looking at that in hindsight, I mean, if the expectation is that more inflation, probably rates are not going down as a lot of people are expecting they might, or they actually could be going up, that'll be a headwind. Also, the U.S. dollar was strong as safe haven behavior. That typically strong U.S. dollar goes against the price of gold. So I think gold can consolidate here still for a few months at this current level, around 5,000. But we're quite optimistic that the opportunity in gold is still there. It's a tier one asset for central banks, and there's less and less confidence in the U.S. dollar, notwithstanding this short-term knee-jerk reaction. And investors will continue to gravitate towards gold. So I think that story is still investors should have a decent allocation to gold in their portfolios.
Okay, good to know. We will leave it there. I appreciate you coming on today and sharing your insight. Thanks so much.
My pleasure. Thank you.
That was Pierre Ouimet, a head investment strategist at UBS. After the break, BCE, CoreWeave, and Cerebra Systems will collaborate to build Canada's most powerful data centers in Saskatchewan. We've got more on that project right after this. Welcome back. Earlier, we were joined by the CEO of BCE, Mirko Bibic, to talk about the company's latest AI initiatives, including a major new investment in Saskatchewan and what investors can expect going forward.
Essentially a partnership where we've come together. Saskatchewan wants to be at the epicenter of AI industrialization in Canada, and so when we start talking about the Bell AI Fabric vision that we have, we just had a meeting of the minds where Saskatchewan's coming forward with 300 megawatts of power allocation, and the Crown corporations, whether or not it's SaskTel that's going to bring fiber to the site and interconnect that fiber to our national fiber backbone, and then SaskPower. We've had really interesting discussions, led to an MOU, and here we are. We're going to have the largest purpose-built AI data center in the country, right here in Regina. That's where I am talking to you right now. We're going to have a media event and an announcement with the Premier later today. They really want to, grow the economy, modernize their economy, and get some GDP going.
Can you break down the price tag a little more? Like, how much is this going to cost, and how much funding, if any, is the Saskatchewan government investing into this new data center?
Yeah, so there's no public money allocated to this. So the Saskatchewan government is not directing any public funds to this deployment. Bell's going to invest $1.7 billion in order to build the purpose-built data center. Think about it as 4 data halls that are going to be brought online by the end of next year, with 2 major global AI leaders as our core tenants for this facility. And those tenants, CoreWeave and Cerebras, will be bringing in the compute hardware to run the AI workloads in the data center. So if you take the $1.7 billion of direct Bell investment and you consider the compute hardware that the 2 tenants are going to be bringing in, we're talking about well over we're talking essentially close to $12 billion of direct investment right here in the province.
What will these centers be supporting, right? Because when you hear AI data centers, it can be supporting a number of different things. This center in particular, what's it going to be supporting?
So this data center is fully allocated. So the 300 megawatts have already been allocated to the 2 customers, Cerebras and CoreWeave, and they'll be using the capacity in order to meet the demands of their own customers, their own off-takers. At the same time, though, we made sure to have the ability. We've reserved a significant amount of the compute capacity to meet sovereign AI demand in Canada for Bell clients.
Obviously, some concerns for local residents when they hear a data center is going into their communities, electricity costs, and those electricity costs rising. So where will the electricity really come from for this data center, and will residents within Regina, I guess, be paying the price?
Well, we're very mindful of kind of the community around us. So first of all, this is going to create a lot of economic activity in Regina and the surrounding area. So that's phenomenal, and we're going to make sure that first and foremost we take care of local procurement. We really want to do that. We'll be plugging into the industrial energy grid here. So not the residential grid, the industrial grid. That's important. And there have been some questions as well around water. And this data center will not draw at all on local water sources. It uses basically technical water. So bit of a quasi-technical term there, but it's not tapping into local water sources at all. And we've got a closed loop cooling system. And those, and as well, there's waste heat that's generated by these AI data centers, and we're looking at developing a district energy grid that we can direct the waste heat to create alternative energy sources.
I was going to ask about water and waste heat, so we got that knocked off now. But just when you were talking about being plugged into the industrial electrical system, does that mean local businesses would be paying the price?
No, not at all. This is power allocation that SaskPower has available for uses like this, and this is going to create tons of economic activity, direct and indirect. So Regina is going to be one of the epicenters of AI industrialization in Canada, which is fantastic news.
Okay, let's talk about jobs now, because Bell's saying construction alone expected to support at least 800 positions, 80 full-time roles once operational. So when it comes to permanent jobs moving forward, that's the 80 jobs?
Yeah, across Bell and Cerebras and CoreWeave, we're looking at least 80 permanent jobs in the facility to run the facility, and of course, this is a big development. $1.7 billion in direct investment by BCE alone over 2026 and 2027. So there's going to be a significant number of construction jobs that are going to be brought in.
You also say, based on industry research, as much as 750 additional community jobs could result from a large data center. I'm just reading off the press release here. What does that mean? Like, what kind of jobs are you talking about there?
Well, when you have the ability to plug into to these AI data centers and direct AI workloads in facilities like this, there's a number of knock-on economic benefits that come from this kind of economic activity in a region, and that's what we're talking about. Standard economic studies show that if you build AI data centers like this, the orders of magnitude of economic benefits continue to spin for years to come. So that's what that's referring to.
Okay, so let's talk a little bit more about Bell as a whole, just before we wrap up here. Obviously, for investors who are listening, since the start of 2026, it seems as though the stock price has been going up. What has your company been doing really to have that kind of increase in that growth that we've seen so far this year?
Yeah, so we started last year when we strengthened the balance sheet, optimized the cost of capital, and then at Investor Day in October last year, we outlined a clear strategic plan based on 4 key growth areas, all tightly linked together and all based on our core underlying strengths. And it's just a question of executing against a very forward-looking, clear strategy. Has ambition. We've built a lot of momentum. One of our key strategic priorities is to lead an enterprise with AI-powered solutions, and that growth vector has significant amount of momentum. This is one of the key planks of that growth vector, and we're going to continue to execute. So we had our financial targets set out for the next 3 years that we laid out in October of last year, and we're already upping those targets given this announcement today.
Okay, and just before we wrap up here for investors, any headwinds that the company is facing in the year ahead? Like, what challenges are you kind of watching out for that you think investors should also be keeping their eyes peeled for?
Right. So we considered headwinds over the next 3 years when we laid out our Investor Day targets back in October, and so that was that was factored in terms of the things we would have expected to see. So today's announcement is around how the AI data center announcement in Saskatchewan allows us to increase those growth targets, and we indicated today on an analyst call that we are not changing any of the guidance targets for the underlying business otherwise.
And that was Mirko Bibic, CEO of BCE. Well, shares of Meta are up after their massive $27 billion deal with AI cloud company Nebius, and we'll have more on that deal right after the break. Stay with us. Meta has formed a $27 billion infrastructure agreement with AI cloud company Nebius. Joining us for more is Brent Thill, the tech sector leader in software and internet research at Jefferies. It's good to have you join us today. Thanks for taking the time.
Thanks for having me.
So I wonder if you can just go through kind of some of the details of this deal. Like, what does it entail? What does it really mean?
Yeah, what it means in a bigger picture is that all the big AI stories, Meta, Amazon, Google, just cannot get enough capacity, and they can't build it on their own. And so they're turning to third-party vendors like CoreWeave, Nebius, other providers to build this infrastructure out to power AI. And every company, including Microsoft, has said that they can't find enough actual physical data center spaces to actually get the systems in to meet the demand that their customers, both enterprise and consumer, are pushing them for. And so while Meta would probably most likely rather build part of this on their own, they have to go to partners like Nebius and CoreWeave to help build this out. And I think while there's not a lot of details that are available, part of this, obviously, with their advantage of having a European-based headquarters, having effectively done this for a while, being a specialist. We cover CoreWeave, and we see the same situation going on at CoreWeave's business is that none of these companies can find enough capacity, and they're having to go. So it's a great win for Nebius. It's great for Meta, where they can diversify away from other partners that they have, like CoreWeave. Many have asked, is this deal competitive against CoreWeave? The answer is, I would think it was competitive against many of the other vendors, but many of the other vendors are sold out. They've just given every ounce of capacity to their other customers, and so we're dealing in a sold out situation that everyone is having to race to go to everyone to build this infrastructure out. So great win for them. We don't know what the exact economics of the transaction are going to look like, other than the revenue. How much money they're going to make on the deal is unclear. But I'd say that I think you're going to continue to see more of this. We're still really early in the AI build out. And it's hard to believe that, we raised our CapEx dollars by over $100 billion for the industry just this last quarter. So yeah, $27 billion deal is a big deal. But to put in perspective, the entire industry is spending, well north of $600 billion this year. I mean, again, big deal. But when you put it in perspective, I mean, we're talking a pretty a meaningful size transaction, but pretty small when you put it in the relative scope of what's being spent.
The way you talk about, how these big companies just can't find enough space, like enough of these data centers and the computers and power that they need, is that something investors of these big companies should be concerned about in the future? Is there going to be more of a scramble to try to find the space they need to be able to, get that return on all the money these big companies have been spending to expand in AI?
Yeah, it's definitely a concern. I mean, the big focus right now is, where's the ROI? Where are we going to see the economic return? And what we can tell you is that because we're at the beginning, we can't sit here and say it's all going to play out. I mean, there are going to be spectacular failures and spectacular success stories. What we know right now is we think AI is paying off for several reasons. One is the backlog booked by the hyperscalers, Microsoft, Amazon, Google, is far exceeding the CapEx dollars. So if you're like, well, you can get, multiple times the bookings versus the CapEx dollars, that's a good sign. We're seeing that. Second, Microsoft told you that they're making more money now in AI than they did in the same point of cloud. So the big cloud build out in the last 20 years, the margins are tracking ahead. So we know that from a monetization perspective. Third is, every board globally is talking AI. It doesn't matter if you're in fashion, aerospace, healthcare, government, retail. Every major board globally. Now, we're not talking U.S. or Canada, Europe. We're talking globally. This is a top 3 initiative. And so past technology shifts from cloud to Bitcoin to Web3 to quantum, you look at all these shifts, like the boards never got involved because AI is such a dramatic impact on how they run. You look at JP Morgan, they cut their actual costs to serve, but they move these people into revenue producing roles. So there's areas, we're going to cut, there's areas we're going to improve, but this has a huge impact on employee labor too, which is one of the biggest costs of your company. So if you can control the employee labor costs, you can improve the outcome of your product, the quality of your product. There's massive implications. And again, what we said is we're so early right now, it's hard for people to believe this, but the early case studies so far have been exceptional. I see it internally in the way we use AI at Jefferies to run our internal processes. We've seen a material improvement in quality of the product, the work, the speed of the work. We're already seeing it. And again, we're like barely into it.
I did want to get there's so much to talk about here in terms of just how fast this is moving, but I did want to get your opinion or your thoughts, I guess, on Meta reportedly planning to cut at least 20% of its workforce. And you talk about, workforces moving forward. Is this the beginning of more layoffs that we can expect to see because of this integration of AI?
You're going to have a lot more job cuts. Again, the tech industry is going to lead with this, right? The tech industry has to eat their own dog food and has to say we're getting more efficient, because if they didn't do it, then they can't pitch it to the rest of the world, right? So some of these job cuts are going to be set because they're signals that that AI is working, and they have to do that because if tech wasn't cutting, like then AI didn't work, right? So when I come out and you see the Block cuts, you see the Meta cuts, they have to cut because they're the ones that are selling the technology to others saying you can cut. So they have to lead the pack in the cuts. The material, the actual magnitude of this cut, obviously Meta has said it's more like a framework, and it hasn't been confirmed that they're going to do it. But I think you're going to see a lot more of this. We saw Block, we saw Pinterest, we saw now Meta talk about it. I think you're going to see a lot more. And every other, we saw it with Atlassian, another company we cover, publicly traded, that had a 10% layoff. You're going to see, in my opinion, 10 to 20% across tech. Yeah. You're going to see some bigger cuts at some companies, and I think they have to lead the charge because they're the ones that are selling the technology. And that's a direct reflection that the technology is starting to work. You're going to see this filter into other mainstream industries, automotive, healthcare. It's going to happen. But again, I want to be careful that I don't think the magnitude of cut. I think today AI is better with people. It doesn't replace people.
Okay. We're going to have to leave it there. We're out of time. Brent Thill, the tech sector leader in software and internet research at Jefferies. Appreciate all your insight. Thanks so much.
Thank you.
Coming up, tankers from Pakistan and India have been granted passage through the Strait of Hormuz. Could this signal an ease on oil prices? We'll break all that down right after the break. Stats Canada says the annual rate of inflation dipped below 2% in February as the end of last year's federal tax holiday helped take some steam out of the yearly price comparisons. Inflation last month came in at 1.8% year over year, and economists were expecting a slowdown of 1.9%. Many believe the data will likely keep the Bank of Canada on its path to hold interest rates. Housing starts across the country climbed in February. Meanwhile, the Canada Mortgage and Housing Corporation says the number of houses being built rose 4.5% compared to the month before. The agency warns, however, that though new construction activity remains relatively steady, the overall outlook remains cloudy. It expects higher construction costs and trade policy uncertainty to weigh on housing starts in the near term. Shares of Dollar Tree are trading higher today. That's after the discount retailer beat expectations for profit and same-store sales in its latest quarter. On the downside, the company gave an outlook for full-year sales that missed estimates. Dollar Tree says the cautious outlook is due to continued tariff uncertainty and the potential for higher freight costs tied to the war in the Middle East. Take a quick look at the markets now. The TSX trading up today after a bit of a slow week last week, up by 0.8% at the moment. And if we look at U.S. markets, similar story there. It seems as though we're seeing a bit of a rebound to start the week as oil declines slightly, giving stocks, bonds the chance to bounce back. You can see that in the S&P 500 and the NASDAQ Composite, which are both up by more than a full percentage point. Tankers from India and Pakistan were granted passage through the Strait of Hormuz over the weekend. The move comes as investors brace for an incoming emergency release of crude into the market. So for more perspective now, I'm joined by Hussein Aladina, Managing Director and Head of Commodities at TD Asset Management. It's good to have you join us. Thanks so much.
Thanks, Lindsay. Thanks for having me.
There's so many developments so quickly within this conflict in the Middle East. I'm wondering what you make of seeing some tankers now moving through the Strait of Hormuz. Do you think this is the start of maybe more being able to get through?
So context, I think, is really important. Each VLCC can carry about 2 million barrels of crude. Prior to the disruption, which is now in the 19th day, the Straits of Hormuz was responsible for 20 million barrels a day of supply. So over 20% of the world's daily consumption flows through the Straits. Positive sign, I suppose, that 1, 2, maybe 3 tankers have gotten through. But in the context of the sort of overall picture, this is by far the largest disruption we've seen globally, again, entering its 19th or 20th day.
I've been hearing reports that Pakistan and India have been granted passage because they're having some kind of negotiations behind the scenes. Is that what it takes at this point for more countries to maybe have tankers move through?
Yeah. So again, speculation, but
Yeah.
the Iranian government has apparently said that sort of folks that are not aligned necessarily to the U.S. and Israel might be granted passage through the strait. Again, like we had something in the tune of 19, 20 million barrels a day flowing through the straits, as well as the natural gas, the fertilizer, et cetera. One or two tankers is great, but the impact that I think we're going to see in energy markets is not yet priced.
I know you mentioned in your notes as well that a Greek ship owner sent a vessel through the strait with its signals switched off over the weekend. I mean, the danger there, is there more potential for more countries to start doing that if this conflict continues and we can't get, as you say, the number of barrels that are usually shipped through the strait through at the moment? Yeah,
we might see a couple of tankers. I don't know too many tanker operators that are willing, even if they get the insurance, to risk their crews. If we're being honest, for every tanker that's gone through, there's probably been 2, 4, 5 that have been damaged over the course of the last several weeks. So I don't think there is a material appetite to be doing this, even if there is insurance. Yes, on a one-off, you might see that happen, and I'm sure the economics for that captain were great, but again, the magnitude of the disruption here is pretty meaningful.
Yeah, no kidding. It's interesting when you look at just how vulnerable, I guess, the energy sector globally is, with everything being, not everything, but majority of oil being shipped through this straight, narrow passage in the Middle East. Is there an opportunity here maybe for Canada, for example, in the energy sector to maybe grab onto something here? I know it's not easy to quickly start producing more oil, but could Canada have maybe an opportunity in the future?
Absolutely. So it's not only the oil that's being disrupted. Natural gas, Qatar LNG is down. This is a huge issue for their Asian consumers that rely heavily on this natural gas. Far quicker actually to take natural gas if we were able to export it from our west coast to Asia. I think if you were Korea or Japan or Taiwan and felt comfortable knowing that you were getting gas from Qatar, I think that equation has changed. And I think that presents material opportunity to Canada on the gas front. And similarly, if I'm being honest, I think also on the oil front, it's a pretty quick passage from the West Coast. We produce some of the best, cleanest oil, heavy oil, which actually Asian refiners have been built to consume. So a massive opportunity, and I hope that the government federally and provincially acts.
It's interesting to watch the markets over the last couple of weeks. So much volatility, right? We're seeing markets up today, the price of oil down. Do you think that's just kind of a blip that we're seeing at the moment after seeing the price spike so much? Are we going to just continue to see some of this volatility over the next couple of weeks at least?
So, Lindsay, if we're not able to get the straits open, and arguably even if we are, a lot of the damage has already been done. But just for some context, if we're not able to get the straits open, the market has to figure out how to ration somewhere between 10 and 20 million barrels a day of demand. That is materially higher oil prices so that we can slow economic growth to challenge oil demand. Libya in 2011, we lost 1.7 million barrels a day. The market didn't price it immediately, but oil did go from $90 to $120 a barrel. Today, the magnitude of the disruption is 10, 15x just in oil. We're seeing refiners in Asia shut down. If you look at cash prices, so notwithstanding the fact that oil is down 5% today, Platts Dubai, for example, for delivery this month is trading over $150 a barrel. Jet fuel prices in Asia have gone up 4x. I think as the market appreciates this disruption, we will see energy prices moving higher.
It's fascinating to see. I mean, domestically, how is this turbulence really feeding into the Canadian market? What are you seeing there, and what sectors are being influenced by it?
Yeah, so definitely you've seen Canadian equities and Canadian energy equities do better than sort of the broader market. But the outperformance that you're seeing in the commodities really underscores kind of the importance of that commodity allocation relative to, let's say, an equity allocation, because even though this benefits the energy names in Canada, the beta or the relationship that they have with the broader market is pretty strong, and why you're not seeing the same degree of performance. But Lindsay, higher oil prices, higher natural gas prices, higher fertilizer prices are definitely a boon for companies in Canada. We're a reliable producer and supplier. And I think consumers will increasingly sort of recognize that, and that should benefit Canada as a whole.
Okay, we'll leave it there. So interesting. Hussein Aladina, Managing Director and Head of Commodities at TD Asset Management. Appreciate your insight. Thanks for joining us.
Thanks for having me.
Up next, top officials from the United States and China conducted a new round of talks in Paris ahead of a planned summit between Donald Trump and Xi Jinping in Beijing later this month. However, the meeting could be canceled due to the ongoing Middle East conflict. So we've got more on that coming up in just a moment. Welcome back. Donald Trump suggested over the weekend that a summit with Chinese leader Xi Jinping may be delayed due to the ongoing conflict in the Middle East. Meanwhile, top officials from the U.S. and China have conducted a new round of talks in Paris ahead of the potential meeting between their presidents. So for more, let's bring in Sean King, Senior VP at Park Strategies, to get a little more insight in all of this. It's good to have you join us. Appreciate your time.
No problem. Good to be with you.
This meeting, I believe, is supposed to happen at the very end of March. Would you be surprised, given this ongoing conflict in the Middle East, if Donald Trump did end up postponing this meeting?
Not at all. In fact, I was surprised that it seemed to be status quo until today. So everybody seems so calm about this thing. It's like, yeah, Trump, it was just like the Maple Leafs making the Stanley Cup or something, regular business. Well, actually, the Leafs never get to the Stanley Cup, so I shouldn't say that. So I'm thinking he probably won't go. And that's just as well, because when any U.S. president goes to Beijing, nothing good comes of it. They usually end up giving a concession as to Taiwan's loss. So right now, I'd say at least 50-50 he doesn't go. And if he doesn't, that's fine with me.
What are the factors you think Beijing is maybe considering right now when considering whether to actually kind of get involved in all of this that's happening in the Middle East or stay out of it? Like, what are some of the big key factors?
You mean whether or not Beijing is going to lend us warships to help open up the Strait of Hormuz, as Trump? Never in a million years. She's got to be in awe of what he's seen our military do technologically, both in Venezuela and Iran, especially considering that mainland Chinese defenses were being used supposedly to keep us out, which were ineffective. And of course, he'd rather have his oil. Mainland China gets 13% of its oil from Iran, and they lost 4% from Venezuela. So with a declining economy, he's already out almost 20% of his oil based on Trump's strikes around the world. But he's also happy to see Trump get stuck and need help on a war that he only consulted Israel on. So, and I support our efforts in Iran, but Xi Jinping is happy to let Trump twist in the wind on this. And whatever oil he's missing, no way in a million years would ever he work with the United States militarily, especially as it's his dream to unite with Taiwan. And it's our arms sales to Taiwan that keeps Beijing at bay. So she would probably rather us not being attacked by Iran, be attacking Iran. But whatever problems we're having there, I'm just sure he's going to sit back and enjoy watching.
And we have seen other countries, right? We were talking about earlier in the show, Pakistan, India, having these kind of back talks with Iran to get some of those tankers through the Strait of Hormuz to get some oil moving. There's potential maybe that Beijing also having some of those talks?
Beijing would have more influence than anyone. Unfortunately, Beijing sells a lot of weapons to Iran, even going back to 2006 when Hezbollah was attacking Israel from Lebanon. They were using Chinese Silkworm missiles. So China's made a big investment in Iran as a political and economic wedge in the region against U.S. interests. But just like North Korea, I think Iran's going to do in its own interest, and Beijing may pretend to involve itself, but really not try too hard. If Tehran's going to listen to anybody, it's Beijing, but who really knows?
If Trump does end up visiting China at the end of this month, do you expect discussions will be limited to talks, or do you think there's potential for an actual trade agreement to come out of these meetings?
Well, what actually happens and what Trump says are often two different things. He may say it's the greatest meeting and the greatest agreement ever. And then, as we've been told, I mean, how many times since his return to office, whether it's London, Stockholm, Geneva, Paris, that the trade imbalance with mainland China has been resolved, and this is great, and Xi Jinping's his good friend. But no, I don't expect any major trade agreement. And the fact that the Supreme Court shot down Trump's tariffs is going to give Xi reason to sit back, bide his time, and again, seeing Trump twist in the wind and weakened. Now, the Supreme Court decision is a win for Xi, but he and the party are not going to talk about it much at home because it suggests a check on unlimited executive power. And that's the last thing that the Communist Party of China wants, is a check on their own power. So I don't expect any substantive trade agreement. My fear is that it would delve into something more political. I know that Beijing wants Trump to say that the U.S. opposes Taiwan independence. For the record, we don't support it. As far as we're concerned, Taiwan's status is undetermined, and this needs to be resolved peacefully between the two sides of the Taiwan Strait. But we don't take a position. And if we were to take a position in Beijing's favor, that would be a serious downgrade for Taiwan. So I hope it would be limited to trade and nothing political. But I don't think anything trade would be that substantive anyway. So part of me thinks he's not even going to go. I hope he doesn't. And even if he does, I don't think anything substantive is going to come out of it anyway.
You mentioned Taiwan, so I did want to ask you about that, too, because over the weekend, Taiwan reported a significant presence of Chinese military aircraft near the island. Is China using maybe what's happening right now in the Middle East as a bit of a distraction to go further into Taiwan and complete some of its goals?
Listen, the PRC has been circling on and off, bombing Taipei territory on the outer islands going back to the 1950s and in the 90s. This is nothing new. If anything, the PLA has stopped flying exercises around the island this week, and that makes people nervous that they're getting ready for something bigger. I don't think that's the case. I think maybe they're just trying to play nice with Trump. Who really knows? But Beijing definitely wants to take Taiwan. They could if they would. The only thing standing in their way is the assumption that the U.S. would involve itself, to which we are not legally committed because we don't even recognize the government of Taiwan. And that's why anything Trump says in Beijing's direction on the Taiwan issue would be a step in the wrong direction. So going back to the beginning, I think if Trump doesn't go, it's just for the better.
Just lastly, last week, the U.S. announced new trade investigations into forced labor practices, including those in China. So would it be advisable, do you think, to wait for these investigations to conclude so that President Trump can kind of reestablish tariff leverage before any meetings happen with China?
I'm sorry, we cut out for a second there. Got interrupted. Must have been mainland Chinese gremlins.
I'll ask you one more time. So last
Sure.
week, the U.S. had announced trade investigations into forced labor practices, including those in China. So what I was going to ask was, would it be advisable to wait until these investigations are actually concluded before Trump heads over to China for more talks?
No, because those investigations are going to take forever anyway. And Trump, even whatever the investigations prove, he's going to do what he's going to do. So those investigations could go on for years. And we already know there's forced labor in Xinjiang, and major retailers are using cotton from there, which is a shame, like Muji from Japan. And they should be embarrassed by that fact. So, and other NDA teams have been over there as well. So those investigations take forever. And whether or not he goes, it should not be influenced by those investigations. And because they're going to give us bad news, and we already know that.
Okay, we will leave it there. Sean King, Senior VP at Park Strategies. Appreciate your time and your insight. Thanks so much.
Thank you.
Still ahead, today's trending trades on Wall Street and Bay Street. We'll dive into those right after this. Welcome back. We're going to take a quick look at what is trending today, particularly on the TSX. We'll look at some of the biggest gainers. Altus Group is up. It is the top performer so far, at least on the TSX, up by 11%. Bird Construction and Celestica both trading up this morning on the TSX. If we take a look at some of the not like laggers on the TSX, really, we're talking about Nutrien, which is down by more than 6%. Go Easy down also by more than 6%. Thomson Reuters is also down, but of course it's midway through the day, so we'll have to keep an eye on these companies. Other notable movers to watch today that we're watching for is Meta, which is up at the moment. Of course, some big news coming out of that company, and Dollar Tree as well. And that wraps up this edition of Trading Day. Thanks so much for watching.